Word up. In today's video, guys, we're going to show you guys how to use the wheel strategy and how you can get paid for buying and selling crypto through options. If you have no idea what options are, check out some of the previous videos I made on the channel and it will give you a better introduction to options. You can also check out the Substack, links in the description below, so you guys can learn a little more about options. Before you start using the wheel strategy, here's a checklist you guys need to have before you start. Do you want to own the asset? You want to pick assets that you are bullish on and assets you want to own for the long term. At one point in this wheel strategy, you will have exposure to the asset. I'll go over that later in this video, and some of these options platforms are only cash settled, so you actually don't have exposure to the asset, but I'll explain it later in the video. Second, what is your overall time horizon? And what's your bias for the underlying asset? Are you bullish on Ethereum? Are you bearish on Ethereum? You have to figure out what you want to do. Don't just start writing options on any single asset. That's probably one way to get wrecked. Next, you want to identify the price you want to sell the put option or the call option. More on this later in the video. Next, you also want to understand that the options platforms we're going to use for crypto, these are cash settled. So when you're selling the puts, if you remember, when you buy a put, that means you're bearish because you're buying the right to sell a certain stock or an asset at a certain price. So let me give you an example. Ethereum's trading at $1,000 and I'm bearish. I think ETH is going to 500 bucks. It would be my benefit to buy a put that says, hey, I'm able to sell Ethereum at $1,000 by a month from now. This is beneficial, especially in a bear market, to buy a put, because if I have the option to sell an asset at a higher price than the current market price, dude, that's a no-brainer. Of course, I'm going to sell ETH at $1,000 instead of the market price of 500 because I have that option contract. But if you're selling puts, it's the opposite. That means you're bullish, because if you're selling someone the right to buy an asset at that certain price, you aren't benefiting from that because you're losing the asset at that point. So something to keep in mind, especially with these option platforms, they are cash settled. I'll explain that more in the video. So if you're already confused, that's okay. I'll talk to you guys about it a couple of times. So again, to reiterate, if you sell puts, this is usually a bullish action. Buying puts is bearish. Selling puts is bullish because you will get the stock if the strike is hit, or in this case, the crypto asset. I'll show you guys what it looks like on Lyra Finance. If I'm going to sell a put, and let's say we're going to do a 1250 strike, or actually 1350 since ETH is at 1358. This means I'm going to be willing to buy Ethereum if it goes to 1350. I'm basically getting paid for this limit order. You see this minimum received of 29 bucks? That means I'm going to receive $29 if I execute this option. Now, if ETH goes to 1349, this option is going to be assigned. This means someone else is going to pick it up. They're going to sell me their ETH, and then I'm going to lose my stable coins as collateral. Remember, these are only cash settled. So with Dopex and with Lyra, you are having to have these cash settled. So you're having to use a stablecoin. It can be DAI, USDC, USDT, SUSD. If that doesn't make any sense, it's okay. I'll explain it more in this video. But remember, you sell a put, this means you're bullish because you're putting in a limit order to buy the asset. You wouldn't buy an asset if you think it's going to go down super low. This allows you to get paid to buy the dips because I'm getting paid $29 to buy ETH at 1350, which is $8 away. So as you can see here, my break even is 1320.75. The reason why this is my break even is it's the premium I receive minus the put price. The put price is 1350. So 1350 minus the 29, and that breaks out to 1320. Just so you guys can keep that in mind. Of course, it's not exact, and that's why it says minimum received. You might be receiving a little more. It always just fluctuates because the price of ETH changes all the time. Let's go and go back to the PowerPoint to just talk some more about wheel strats. So if you sell a call, which is the other side, this means you think the price is going down. Whereas buying call options is bullish, because if you buy a call option, this gives you the right to buy that particular asset at that certain price. So this means these are limit orders. Okay, so the first part of the wheel strategy. If we sell a put and it's executed, we now have our stables turned into, well, ETH in this case if we're trading ETH. Now remember, these option platforms are cash settled, so you're not getting ETH. You're actually getting difference in stable coins back. So if you have the price at $1,200 and ETH ends up trading at 1,100, well, you will get back about 1,150 or 1,140 stable coins. So you'd lose about $60 worth, because that is the difference in the two strikes plus your premium. Let's say you got the $40 in premium. That means you lost $100, but you had plus 40 because you got the premium. So you really only lost 60. These are cash settled. So to execute this part of the wheel, if you do get that cash back, you would market buy Ethereum, and then you can use the Dopex SSOVs, or in this case, you would just take the other side of the trade and start to sell some of the puts. Your goal at the end of the day with the wheel strategy is to have a profit based on the difference of selling the puts and selling the calls plus your premium. That is where you profit. So to reiterate, if you sell a call, you typically think the price is going down. Buying a call, you think it's going up. So since these are cash settled, you don't want to go nuts with the expiration date. So you don't want to do one like 2 months, 3 months from now, and Lyra Finance will allow you to do that. Be careful. Crypto is volatile and your funds can be locked up for a while. I'll show you that later in this video so you guys can see where the collateral is, etc. But yeah, be careful with that. So the intro. Only do this with assets you want to own. Second, you need to know what a put option is and how to sell a covered call. Well, put option gives me the right to buy a particular asset at a certain price. Selling a covered call is basically selling calls of an asset that I already own. If I'm selling 10 ETH calls, but I hold 10 ETH, it's kind of like a covered call because I have exposure to the asset, but yet I'm also bearish the asset because I'm selling calls, basically locking in my profit. So selling covered calls does a couple of things. First, this limits the profit potential, and it doesn't eliminate the downside risk. Because if you have the asset and the asset goes to zero, you lose all your money. However, it does reduce the risk by the price of the premium received. So if I'm selling a covered call and they're paying me $5 for a stock that's worth $100, that means I'm profiting a 5% yield on the duration of that option. So if that option is for a week long, it means I'm profiting 5% in a week. And you multiply that by 52, that means that yield for that year, if you compound it, it's probably about 400 to 500% APY. So here's an example. I purchased a stock at $100 and a call option is sold at $105. That means I own this stock at $100, and let's say the market price is $100. My call option is technically my limit order. So at 105, my stock will be sold and I will get dollars in exchange. So my strike price is 105. And let's say, for example, I'm getting paid $5 to execute this option. Well, that means my buying cost is not $100. My buying cost is only 95 bucks. That's my cost basis because it's the amount I spend minus the premium. So if I spend $100 and I take in 5 bucks from doing this option, I basically only spent $95 for my position. Again, I'll give more examples later in this video to explain it, but the TLDR on this is that my break-even point is 95 bucks now instead of 100 bucks because of the premium that I gain. I do have exposure to the downside because this is a covered call. So if I buy ETH at 1,000 bucks and it goes to zero, I can lose all my money. So the downside risk is infinite. Options, if you're dealing with stocks, are typically traded with 100 shares of that stock. But with crypto, it's a little bit different, especially with something like Lyra Finance and Dopex. But we're going to stick to the Tradefi example so you can understand it. So if this stock closes above $105 at expiration, I will have a profit of $1,000. The reason why it's $1,000 is because it's the $5 per share times 100, which gives me $500, which is the premium I got for writing the call option, and the other $500 is coming from the profit I received. If I bought the stock at $100 and I sold it at $105, that means I profit $5. And then you multiply it by the 100 shares, that means it's $500. So to reiterate, on simple terms, if it's just doing 1-to-1, I buy a stock at $100 and I sell it at 105, I profit $5. And just for writing the call option, I get paid $5 per share. So it's $10 total right there. The reason why it's 1,000 is because it's $10 times 100, because you have to do this with 100 shares just in Tradefi. Now in crypto, it's a little bit different. I'll explain it later in the video. Lastly, to have the covered call, you must have the asset. Now for Lyra Finance, that's not the case. For Dopex, yes, you do, especially if you're doing the SSOVs. I'll show you that later. So the benefits of covered calls. If you're trading stocks, you can do this right before dividends. So if Intel Corporation is about to pay dividends, you can do a covered call on this because you own the stock at that point, and then you can lock in a covered call to sell it. You will basically get those dividends on the stock. Now, of course, the stock could plummet and your call can never be hit, so you're stuck with the stock. That's for another day. Second, this forces you to take profits and select your profit points and get paid to do it. So if I buy ETH for $1,000 and I sell a covered call at $1,100, that basically says I'm committing to selling my Ethereum at $1,100 and getting paid a premium for doing this. And of course, if the strike price is never hit, I get this premium for free, I walk away, and I can repeat the process if I want to. I'll do a demo later in this video to show what's up, so it'll make a little more sense. Now here's some screenshots from Lyra Finance so you guys can take a little look. So basically in this example, as you can see here, if I'm selling Ethereum at a $1,200 call price, this basically means I'm getting paid $121. So for writing this option, I'm going to get paid $121. I know you're saying like, Drake, whoa, the price is not $1,200. The price of ETH is $13.50. What are you doing? Well, yeah, that's the reason why you're getting paid $121. You probably wouldn't want to execute this, but hey, it is what it is. You can do what you want. Remember, if you're selling the calls, that means you're bearish because you're selling the actual asset. So there is a chance that it drops down lower, but you can see based on this profit and loss, your maximum profit you will ever make from this is $121. It means if ETH goes down, the most you will ever make is $121. And if ETH goes up, well, you can get liquidated pretty rough and you'll lose your collateral. As you can see here, my collateral is $500. So if you're using Lyra Finance for the covered call, you're actually having to put up stable coins for this. So you're having to put up collateral to take on this position. But if you calculate and factor it in, if you're taking on this ETH covered call, and let's say it's for 7 days, you're basically earning $121 on a $500 deposit. That's an extremely juicy yield. If that's only a week, that's a 20% yield in just a week. Multiply that by 52, and you're talking over 1,000% APR. That's nuts and ham. So that's how you'd explore the covered call on Lyra Finance. So on Dopex, ignore the title, you can deposit ETH instead of SUSD. This means you can actually use Ethereum instead of some stable coins. You can earn a pretty juicy yield on this. This is the SSOV vault. So basically, if I'm selecting a $1,600 strike, that means based on the dates of October 7th, if ETH is not trading at $1,600, I will get the premium as well as my Ethereum back. But if it goes over, I will get the difference paid back in ETH, and of course, I'll still get my premium. So in this example, ETH goes to $1,600, some of my ETH will be sold, and I would get the difference plus premiums plus rewards. Now, if ETH doesn't hit the strike price, I will just get my ETH back and the rewards. So that's if it's not assigned. By the way, guys, if you guys are enjoying this type of content and if you're enjoying this video and it's bringing you guys any value, you can support the channel by smashing up the like, subbing to the channel, and telling me what you guys think of the wheel strategy so far. Okay, so we have all that jargon. Now, where do we start? Well, if you could see here on Lyra Finance allows you to deposit stablecoins, and Dopex also does stablecoins, but it allows you to do Ethereum if you're selling the covered calls. These are in the SSOVs. I'll do a full demo on the actual platforms itself so you guys can understand them better. So where do you start? Well, it depends on the protocol you use and your outlook on the asset. Since these are cash settled, if you think now is a good time to buy some of the underlying asset, in this example you want to use ETH and preferably covered calls with a price that's you don't think it's going to even hit. So if ETH is trading at $1,200 and you think it's never going to hit $1,600 in a week, well then an SSOV deposit vault on Dopex is going to be your option because you get the premium and you still have exposure to your ETH. Keep in mind, if it gigamoons, you're going to lose a portion of your ETH, but hey, that's why you're getting paid the premium. So using Dopex, you have the asset, whereas with Lyra, you are just using stablecoins as collateral. Next, you need to decide if you're bullish or bearish. If you're bearish, you would sell the calls, but with a lower strike price. So if I own some ETH at $1,200, I would probably do a strike price at $1,250 or as close as I can. That way, if it gigapumps, whatever, it sells it, I lock in my profit, and I get paid the premium. Now, if you're bullish, then you would sell the puts. Now, keep in mind, it's a little bit different using the options platforms in crypto because you don't get the actual underlying asset. It would be nice to see a protocol that does that, but currently you are just having cash settled on all these option platforms. So if you're bullish, you sell the puts because you're selling the right to someone else. Because when you sell a put, you're basically committing to buying that asset. Because if you remember, if you buy a put, you're bearish. If you sell a put, you're bullish. Because you're basically committing to buying that asset from that guy who's selling it. That's how you can think of it. Now, this is how the wheel strategy is played in Tradefi. You would use it to lower your cost basis. So in Tradefi, options are not cash settled. So if I was selling a put option, I would basically be setting a limit order to buy a stock. So if Apple is trading at $100 and I sell a put option at $90, that means if Apple drops to $90, I'm buying that stock. My US dollar is going to be swapped for the stock because I put in that put, and of course I earned that premium. So I didn't use those prices, but yeah, if you sell Apple with a strike of 100, trading at 120, I get my collateral back plus a premium. Now also the opposite is true. If I put in that put option, now the opposite is true. If I commit to selling that put option at $90 and Apple ends up screaming to 120, well, I get my collateral back and I get the premium. Of course, I don't own the Apple stock, but whatever, that's for another day. So options allow you to lower your cost basis and get paid to buy the dips and sell the rips. So here's the example of the wheel strategy in DeFi. Let's use this example with Dopex. I buy one Ethereum at $1,200 and I decide to go ahead and sell some covered calls. My cost basis for one Ethereum is $1,200 because I bought ETH at $1,200, one ETH at $1,200. Now, let's say I sell a covered call at $1,400 expiring a week from now. This means that I'm basically putting in a limit order at $1,400 to sell my ETH. I'm going to get paid a premium for doing this, so keep that in mind. So at the end of the option term, the strike is not hit. I will get my 1 ETH back and a yield. Let's say the yield is 0.05 ETH if I'm using Dopex. That means I now have 1.05 ETH and my cost basis is only 1142. Let me reiterate why it's 1142. If I have 1.05 ETH and I only spent $1,200, that means my cost basis would be lower because I have more than 1 ETH. I got more than just 1 ETH for the $1,200 that I spent because of the premiums I received. So you can't technically complete the full wheel in DeFi since these are cash settled, but the same concepts apply. So the main difference here is that you get the difference back in cash. So it's kind of doo-doo, but at least you can just go market buy the asset when you get that back, and you can consider the premiums, etc., and still get paid to buy the dips and sell the rips. So here's an example on Lyra Finance. If I sell a put option on ETH with a $1,000 strike and put up 565 on collateral, as you can see here, the 565, that means I will get about $12 in the premium. And this is for a week term. So $12 and 565, that's whatever. It's not too bad for a week. So as long as ETH doesn't go below 988, I'm going to break even. But if it goes below that, I'll lose some money. And if it goes even lower than that, I basically get liquidated. So it's one of those things, do you want to enter this or not? So you also have to factor that in as well, the risk involved, especially on the positions. So you need to understand how options work before you're executing any of these strategies. So in DeFi, if you want to fully play out the wheel strategy, the price hits my strike, and depending on how low it goes, I will get that difference back in stablecoins. At that point, when I get those stablecoins back, I go to market buy that Ethereum. Because if Ethereum trades at 700 bucks, I can now buy a little more than 1 ETH because I will get that collateral back in stablecoins plus my premium. So I can go market buy the ETH, and then I can go ahead and execute the covered call option. So that's the wheel. You're selling puts, and then after that put is executed, as in you get that asset, you now come back and then you sell covered calls, which you're owning the asset. So when someone buys your asset on the covered call, then you do the puts, and you have this little wheel. That's why it's called the wheel. So let's go ahead and do some demos on Lyra and Dopex. It's about time, Drake. All right, so Lyra Finance. Let's go ahead and do this sauce. I'm going to go ahead and sell a put. I don't have any Ethereum yet. I'm going to go ahead and sell this ETH put so I can go ahead and get exposure to ETH. ETH is currently trading at 1358. So I'm probably going to sell a put at 1350 because why not? It's $8 away. I'll go ahead and get some ETH in exchange. I mean, of course, I won't get the actual ETH, but still, it's paying an okay premium. It's not too bad, and it's $8 away. So that means that ETH would have to go as low as 13.19? Yeah, it'll have to go to about $1,320 for me to just break even. So I got a little bit of wiggle room there. It's okay. I don't have exposure to ETH. I'm bullish on ETH long term. And of course, the contract is only for a week. So if ETH ends up gigamooning from here and it just keeps going up and up and up and up and up, that means, well, I'm okay because I'm selling these put options and no one's going to buy it, because why would someone buy the right to sell ETH at 1,300 bucks when the market price is 18, 19, maybe $2,000? So I will get my collateral back, plus I'll get $29. So if I executed this, and let's say I did 10 contracts, whatever, my collateral is going to be minimum. It has, yeah. So let's see. So my minimum collateral in this position would be $4,400. So as you can see here, if I wanted to do 10 contracts of this, I would be profiting 287 bucks, and I would only have to put up $2,800. You want to be careful being that low on collateral, because if ETH makes a scam wick to 1336, I'm liquidated. So you probably want to go on the safe side and give a little bit of buffer room, especially since you have this contract for about 3 more days. So you do have to factor that in, and the worth. So basically, I'm going to earn $287 instantly as soon as I deposit this collateral. But I have to factor in, if ETH drops below 1350, my stablecoins are going to be sold to Ethereum. And since these are cash settled, I'm not going to be getting Ethereum in exchange at the end of the contract. I will actually be getting the difference in stables. So if ETH is at $1,300 now and it goes to $1,000, and I did this for 10 options, that means based on this profit and loss calculator, I would lose $3,200. So I would lose $3,200 of my collateral, which I put in $5,500. I'm not too happy about it, but hey, it is what it is. At least I didn't get liquidated and you learn a lesson. But I did get a premium of $287, so that's good. But on the other side, ETH gigamoons, no one buys my put option within the next 3 days. That means I will keep the premium, which is 287 bucks, and I'll get all my collateral back. I'm a happy camper. I got my collateral, I got my premium, and I can repeat this process. So now, if the contract is executed, as in someone gets my put option, that means after this is done and this is closed, I would have to go market buy the ETH, and then once I market buy the ETH, I would come over to Dopex and I can use some of the SSOVs. You can also use Lyra Finance as well, but I prefer Dopex and its ability that when you deposit into any of these vaults, you can actually use the underlying asset. So you don't have to do stablecoins. So in this case, we come over to Dopex, we take a look. I got my Ethereum, let's say it was for 10 contracts, I now have 10 ETH. I would come over here, deposit 10 wrapped ETH, and I'm thinking, I don't want to sell my ETH. I want to keep it, and I just want to get paid. I would do something wild like 1,600 or maybe 1,450. That way I can get a little bit better premium, because your maximum profit with these options is that if my strike price is 1450 and ETH is trading at 1450, I'm going to get the maximum possible premium, because no one's going to buy that call option because I can just go straight on the market. So that premium that was paid for it is just going to expire. I'm going to lock in that premium. It's a win for me. I'll get my ETH back and I will get the premium in exchange. So I'm happy. Sauce, let's go. Make any sense? Just replay the video a couple times. It'll kick in. It takes a little bit to understand. Learning this stuff will set you apart from the rest of the 99. A lot of people don't know how to trade options, and a lot of people don't know how to use them. They just like to buy Doge and move on. So learn how to use this stuff, whether you're going to use it or not. It's nice to understand it. That way you know a little bit about the market movements and psychology. So to reiterate, a successful wheel is when you make a profit from the difference in buying and selling of a stock or crypto plus the premium. So if I'm buying Ethereum at $1,200, selling it at $1,300, that means I profited $100. And then let's say I got $20 on each transaction. That means I profited $140, because on the put side and the call side. So that means I made $140 for buying and selling an asset that I'm bullish on. So summary, only do this strategy with assets you want to own. For crypto, since it's cash settled, preferably use less volatile markets so you can properly deploy this strategy without, getting wrecked. You need to know what a put option is and how to sell a covered call. So the reason why they call it a covered call is because you're selling calls on the asset you own. That's why it's covered. You own the asset and you're selling a call on it. It means you're owning the asset and you're also bearish on it at the same time. So bullish, bearish. Selling calls is bearish. Buying calls is bullish, because that means you can get the asset at a cheaper price. So if you're trading in stocks, covered calls are a great way to grab by the dividend date. Anyways, guys, thanks for tuning in. I hope you guys enjoyed this video of the wheel strategy. It might be a little confusing. Just play the video a couple times. Check out some of the previous videos on options so you guys can understand it. But I'll be doing more videos on option protocols, DeFi strategies, as well as other projects I'm looking at. Go ahead and subscribe to the channel if you like to see stuff like this, and let's hit you with that wisdom online. Proverbs chapter 11 verses 2. When pride comes, then comes disgrace, but with humility comes wisdom. That's so true, man. Be humble, be wise. We'll see you guys in the